I'll try to be fast. My presentation will be a mix of policy, a bit of discussion, and also Lithuanian case study. And also, first of all, I would like to thank my team, people from Financial Stability Department who contributed, who assisted, and we discussed a number of topics, and that was very helpful, and they all contributed to this presentation. I'll move quite fast, and let me to remind you, for those who haven't been here yesterday, briefly, sort of where inspiration came from for this conference, for the main question of the conference. So I was actually puzzled myself that often, and even today, policymakers claim that they do not target house prices, and I even have 3 examples by three central banks explicitly saying that this is house price. It's not our target. We just aim to reduce risks coming from credit, overextension of credit and indebtedness, and for the purpose of, for example, UK Treasury, they were saying the risk which these risks would pose to financial stability and macroeconomic stability. But despite what policymakers claim, they often react to house price changes. You cannot do nothing when house prices are going up by a quarter, like in Norway, for example. Definitely you have to act. And the fact that, which was actually highlighted in the previous session, that exposed policymakers evaluate themselves by looking at what happened to house prices. We could interpret it as a signal, but as Richard highlighted, actually the general public and also probably in other cases, they will look what's happening to house prices, unfortunately. So, with this in mind, so why house prices are important? And that's, of course, the starting point is always macroprudential policy objective. And here is this conflicting issue which we touched upon previously. So, and this is a quote from by Alex Brazier, Executive Director of Financial Stability from the Bank of England, from his speech. The purpose is to protect the real economy from the financial system by protecting financial system from the economy. So most macroprudential people would agree with the second part, so the focus is on resilience, but the first part, it's really the conflicting issue. But nevertheless, it's being debated from time to time, and ultimately, protecting the economy from a financial system, you could also include the housing market as well, in that sense. And it's about smoothing consumption, or even, you could say, aggregate demand, sort of to ensure that GDP growth is stable all the time. This, of course, brings a question of cooperation of macroprudential policy and monetary policy as well. But these are difficult questions. And ultimately, we would all agree that high indebtedness and high asset prices, including house prices, means more risk. And it's well known how it works. The transmission channel, so burst of house price bubble affects the economy and aggregate demand through, among other things, wealth and confidence effect. So by wealth I mean that for most households, housing is a major wealth component. This is not proven. Whether housing reduction value, what are real effects for consumption, this is still topic for research. And of course that ultimately those bursts of housing troubles, that leads to high unemployment, reduced construction activity, and less credit amid credit losses for lenders as well. And the obvious fact, which was already mentioned a number of times here, that real estate crises are longer and more severe, and that justifies additional focus on house prices in this way. I'm not going to describe this chart, which was very well described already in John's presentation, so I'll skip that immediately. And the property market, the housing market, is very important. This is one way of describing it. I'm not going into detail, but property market is very much linked to households and real economy and financial sector as well. And I just quickly will give an example how it is linked to the economy. And of course, the obvious link with the economy is the construction activity and contribution to GDP, to gross value added. That's obvious. In the case of Lithuania, it's roughly the same as in the euro area. The second link is through the financial sector. This chart was in Dirk's presentation as well, so I'm not going to mention that. So the financial sector is really very much exposed to real estate through the lending, real estate-related lending. On this slide, I'll spend a bit more time. This is actually how households are exposed to the housing market. And this is the wealth effect I was mentioning. In the case of Lithuania, it's a primary form of wealth which most people have. And the chart on the right suggesting that home ownership in Lithuania is quite high. So housing markets basically to every person. And why this is why it is so sensitive, and to use the points made by John Danielson, so why there are more happier people when housing prices are high. So because everybody's exposed, in a way they feel better when prices are rising. But this is an important, and I think, message, and so the value of housing stock is much more important than any other financial holdings, at least in the case of Lithuania. I don't know whether this is the case in other countries where already with large pension systems with accumulated assets, but at least in Lithuania, it is very important. We don't have research. I don't know how important it would be wealth channel for consumption, but it's likely to be relevant, definitely. Then I move on to assuming that macroprudential people decide to focus in one way or another, just dampen the cycle, or maybe targeting is too ambitious. But what are the practical challenges? And there are many of them, for sure. First of all, about the timing and target specification, when to act, and there are also implementation, transmission lags, and also what instruments should be used, how to calibrate them, a suite of models is needed, and also interactions with other types of policies. Fiscal, monetary should be considered, and also the question which was mentioned by John as well, maybe macroprudential instruments are not the best tools in town, so to say. Maybe there are other ways. And just I thought that interesting to mention that monetary policy is also affecting or is reacting and also being assessed by what's happening in the housing market, because in consumer price index, rental costs account for, at least in the case of Euro, for 6%. In Lithuania, it's only 1%. So monetary policy is targeting actually housing market in a sort of in a rental market, a rental part of the housing market in a way. And of course, communication challenges. There was a sort of a risk of what if we don't succeed? What if we the impact on house prices were not that large, and that what would be policymaker, what response would be, and what could be said in that case. Now this is an updated sort of a few words about detecting. So I think there is hope that given the work which has been done, there is some hope that probably next time we would be able probably to detect housing bubbles. And this is an updated chart from the ESRB report on the real estate market and financial stability in the European Union, which was published at the end of 2015. And so yellow countries, so to say, which are included in the yellow group, are the ones which said that during the great financial crisis, their crises were related to the real estate market, and the green countries in the green area, so all else. So, for example, Greece, I think, is in the green area, despite we know that there was a severe crisis in Greece, but it was sovereign crisis. Whereas in the yellow part, these are countries with real estate crises. And as you can see, in the case of household credit-to-GDP gap, so it was substantially higher in those countries. And so there is sort of hope that next time probably it would be possible to predict, but also by way the fall was actually much stronger in that case as well. If we were to use price-to-income gap, so there is also we have the same case that those countries which had real estate-related crisis, so in their case, price-to-income gap sort of increased before the crisis substantially, and it has been increasing for a number of years. So if we observe a similar dynamics, we could say it's quite a strong signal that that something is bubbling up. So there is some hope. This is the period I was actually mentioning. And then another practical question, what indicators to use? And of course, I'm not going into detail, but from my point of view, at least the current thinking, and given what Hong Kong was doing, price-to-income ratio looks the most promising in that regard, because it's not only about the price levels or growth, it's also about sort of fundamental factor about income. Income is included. But since this is a ratio, it is driven numerator by denominator, and the volatility actually of numerator is much larger than of denominator. So the ratio itself will be mainly driven by volatility of house prices. And here I also provided sort of the ratio itself and the composition of that ratio in the case of Lithuania. As you can see, before the crisis, it was very much driven by housing prices. And currently we have a situation where it is more or less stable. So despite that, actually, for example, last year, housing prices went up by almost 10%, but wages were growing quite fast as well. So it's difficult to say that, there are no fundamental reasons. This is one of my favorite charts. So the author, it's taken from the paper, and the author is from New Zealand, actually, and he mapped macroprudential policy actions in Hong Kong to developments in house price to income ratio. And this is probably, you could say, an example of not house price targeting, but more house cycle dampening, and this is what actually Hong Kong authority is saying for what they were aiming at. So they really wanted to dampen the housing cycle for obvious undesirable side effects. And whether they were successful, it's up to you to judge. But and again, this is using price-to-income ratio and also trying to tackle imbalances in the housing market. So a few details about borrower-based requirements in Lithuania. This is actually the main tool. What we focus very much on it because of its power. It's very powerful from our point of view, more powerful than capital-based measures, especially because banks are well capitalized. So I won't go into details, but what is important, the changes in 2015. Yesterday I was asking a number of speakers, what were your ex-ante expectations? How, after 1 year, how are you going to judge yourself whether you achieved your objective? And in some cases it was very difficult. We just want to reduce indebtedness, but by how much, until when, and sort of what is the optimal. It's very difficult to specify with those things, I know, but at least in our case in 2015, we were in a situation where we had creditless recovery. So after the crisis, economic growth recovered, but there was no credit. So at least with these measures, we realized that because of low interest rates, we needed to do something, because with the SCI and 40-year maturity cap and without interest rate shock test, effective theoretical DTIs, which were possible, but banks, of course, not lending at those DTIs, was like 13, 14. Of course, we could not accept that. We had to amend the framework to remove that possibility. There's kind of not a leakage, but I would say a drawback of the framework. So we shortened, of course, maturities, introduced maturity caps, shortened maturity to 30 years, introduced an exception for new loans for 5% to accommodate really special cases, to leave some leeway for the banks, a speed limit of 5%. But the key feature is that it's 5% interest rate test. But in that case, the main message is that we have an explicit goal was not to staunch household credit recovery. You could say it's an easy goal, but we were in a situation, we are really concerned that we calibrated measures looking at credit register data, so that really given the past credit flows, that the impact would be minimal for aggregate credit flows. And it seems that we succeeded. If the red line, actually the vertical line, this is when these measures were introduced, and the green line shows the credit flows. And the sort of light yellow is a moving 12-month average. So as you can see, people for some reason, there was basically we calibrated in a way there was not serious sort of tightening measure, but nevertheless there was some pickup in activity before introduction, then drop, but then eventually credit continued to grow. This is actually what we aimed at, and so preventive purpose of those measures is there, and at the same time the credit growth wasn't staunched. And the interesting point in 2011 was, you could say, we were at the bottom of the cycle, and introducing requirements is quite bad timing, but nevertheless, it was introduced for preventive reasons, and there was very little credit anyway. So the impact, even though it was, of course, introducing these measures, is tightening effect, but it had no effect because there was no lending almost. And even all banks, well, almost all, the biggest banks at least, were very supportive. I wonder now, it's definitely wouldn't be the case. Just Lithuanian issue, but we are focusing, we have a new concern, which is buy-to-let market, given the low interest rate environment. So on the left, we have the share of secondary flats in the top 5 cities and also in resort areas. The important thing is that on the right column, we see that share has increased over the last 2 years quite substantially. So this is, we're learning, we're analyzing that market, and this is it's going to be our focus. The next part of my presentation is about new trend and challenge for all of us. Eventually, we will have to look into this issue. It's about location-based macroprudential policy and pros and cons of applying regional macroprudential measures, which a number of countries already done that. In Asia, they were more active, but now we have examples in Denmark and Norway. So what is the case for measures dedicated for the biggest cities and capitals in particular? Capital cities are special. Substantial shares of population live there, and those shares have been increasing, as you can see from the right part of the chart. And this is going to continue. Urbanization is set to continue. These are charts of the forecast from United Nations. So the trend is very clear in all parts of the world. But demographics, as important it is, at least in Lithuanian cases, is a Lithuanian feature, relying on official statistics is not enough. We have a huge immigration issue, but we have this internal migration issue. And this is an example. So this is data about Vilnius inhabitants, and the green part is official data, and the red part refers to people who registered for primary healthcare services providers in Vilnius, but they're not officially registered for other purposes. So in fact, this is the right amount of people living in Vilnius. So really, assessing and also for assessing developments in the housing market, demographic is really important. So having the good data is important. This is very much similar to what Dirk was describing in his presentation. So whether dynamics in capital cities are different from the rest of the countries. In the case of Lithuania, there is a stronger movement, but there is some, and the hypothesis could be that what happens in capital cities spills over or leads developments in other parts of the country. There is some preliminary evidence that in the case of Lithuania, it could be the case, but some additional testing is needed. At the bottom, people ran some grandeur causality tests. In some cases, it looks like it might be the case. Again, so in the case of mortgage portfolios, half of the portfolios are secured by collateral in the capital city. So again, the exposure to capital city, banks are very much exposed to what's happening in the Vilnius property market. And at the same time, the borrowings, loans secured with collateral, Vilnius-based collateral, tend to be the market itself is much more dependent on leverage in that way. So there are more transactions actually financed by banks. Interesting point is to look whether liquidity is different in capital city compared relative to other cities, and this is one way to measure liquidity is to compare the number of housing transactions per 1,000 inhabitants. As you can see, there is no significant difference. Maybe in the capital city in Vilnius it's a bit higher. The Klaipėda is kind of resort area, so it's a different story probably, but no sort of Vilnius doesn't stand out in with respect to per capita activity, and also it's the same case in relation to total housing stock. Basically, it's more what we usually do for equity markets, so number of transactions compared to the total number of apartments. And these are actual examples of location-based macroprudential policies, and most of them, or in other cases, you could say this postal code-based or other geographical criteria-based policy would be arbitrary, but there is a way around it. For example, one way could be to use price per square meter thresholds. In that way, if a price of square meter is above a certain limit, then those measures would apply. In this way, you avoid this arbitrary sort of geographical discrimination. And my final slide. And I was really struggling, I have to say, with my final slide, how to summarize all that dimensionality of the topic. And I decided to present you a hypothetical case for the not-so-distant future in Lithuania, which is actually not so hypothetical and could actually become a reality. So a number of assumptions here, a number of statements are here speculative, but some of them actually could be considered quite a sort of reasonable forecast. So when looking at the housing market, so on the one hand we have, and I'm assuming in some point in the period ahead, So house prices become a serious concern because house price to income ratio has been rising for a number of years, and we saw that it's a good leading property for the problems, for the potential crisis. Housing assets are a major household wealth component, and in addition to that, there is substantial potential for reduced consumption or reduced aggregate demand in the event of price correction. So we see this sort of macro impact there could be substantial if house prices were to decrease. So this is the case for doing something because of sort of hot situation in the housing market. But at the same time, banks are capitalized, all the macroprudential buffers are in place. And in the case of Lithuania, seems to be really the case. There are no serious supply-side constraints. So the building restrictions are not that binding. So it really seems that the authorities, municipalities are flexible in that regard. We don't have interest rate distortionary interest rate deductibility, tax deductibility. It's not there. At the same time, because of our borrower-based requirements, individual household indebtedness seems sort of manageable. And aggregate household indebtedness is still very low by international standards, because I think we are from the bottom three when we compare all EU countries. But nevertheless, that was the case also before the most recent crisis, but the impact of the crisis was really severe. So this low number should not be the most important indicator, because for other countries, especially in the Nordic countries, this household indebtedness is much more significant. In our case, it's not that large. So the question would be to act or not to act for a policymaker. And if yes, then how? Maybe, as was highlighted by John, maybe it's not the most appropriate, macroprudential is not the most appropriate policy to act. And if all this applies largely to Vilnius only, and then we should do something for Vilnius and leave the rest of the country unaffected. So these are difficult questions, and this is I don't have a definite answer myself, but it looks like a serious case to consider. And I finish my presentations by asking to the audience, what do you think? What would you do in that particular case? Thank you.